Jobs Day here in the U.S. That headline data coming in a bit mixed here to maybe on the soft side, as we certainly heard in our last segment. Non-farm payrolls rising by 49,000. The unemployment rate, however, falling 0.4 down to 6.3%. Yahoo Finance's Brian Cheung joins us now for a look, Brian, at some numbers that you've been able to highlight here as you've taken the last 15 minutes or so to go through this report.
Yeah, absolutely. Well, we look at the headline unemployment rate number. Obviously, that's good that it went down from 6.7% to 6.3%. But when you unpack that by race, you can see that the uneven recovery is still very much the case. When you look at, for example, the white unemployment rate being 5.7%, that's a decrease from 6% in December. But you look at the Asian unemployment rate, noticeably ticked up in the month of January. It actually went up from 5.9% in December to 6.6% in January. And of course, you look at the black unemployment rate, still almost close to double digits at 9.2%, although it did tick down from 9.9%. You guys were pointing this out also earlier in this segment, but you also unpack the types of industries that were affected, and you do see how the recovery is also uneven. So yes, we did see on the top line non-farm payroll gains for this month, but when you look at leisure and hospitality, for example, that industry continued to contract in the month of January. It lost about 61,000 jobs, whereas the gains were coming from professional and business services, likely to be more high-wage, high-earning jobs, because those are legal services, for example, the advertising industry, software engineers, things like that. Although there is one little bit of silver lining within that, which is that a lot of the professional and business service gains were in specifically the temporary help services part of the BLS report that actually gained by about 81,000 in the month. And for those that don't know what that might mean within the context of how the BLS defines it, temporary help services would be headhunters or HR people that are recruited to find people to fill jobs. So you can actually see this as something of a maybe leading indicator for jobs coming in future months. You don't want to read into it too much, but gaining about 81,000 of those headhunter jobs could show that businesses could be ready to hire in the coming months. Very interesting to watch in the months ahead. Myles?
And maybe, I guess, did tax preparers fit in there? That was my first thought, is that people were staffing up for tax season, but I don't know exactly
professional
what.
Business services, yeah.
Yeah, technically that would fit in there. And then just, Brian, we have to ask you about, we heard from Jay Powell about 10 days ago, how the Fed might think about this. I can't imagine that this changes their view, but it is also interesting that we now live in a world where the unemployment rate, it matters, but there's no Evans rule. We're not waiting for some magic number. And so that 0.4 decline is, it's not really a needle mover, which is interesting in the context of how we thought about things during the last cycle.
Yeah, absolutely. And when we talk about the unemployment rate, that seemed to be the big guiding star in addition to obviously wage growth coming out of the last cycle, right? These kind of Fed officials were worried that once the unemployment rate got so low, there would be a point where inflation would inevitably start to tick up. But what we see is that you don't even hear Fed officials talk about the idea of wage growth anymore. And that's because of the decoupling of the relationship between the unemployment rate and inflation. We can get into that at another time. But broadly speaking, what we've heard from Fed officials is that in the context of this specific recovery, they're going to be looking at a dashboard of indicators beyond just the unemployment rate. And for that matter, we saw 3.5% unemployment rate before we got into this crisis. So would it be something close to that that would meet the Fed standards for shortfalls of maximum employment? We don't really know, but you heard from the likes of Jim Bullard from the St. Louis Fed earlier this week saying, if you could get to 4.5%, that might not even be enough. So I think we see that it's a high standard for the Fed. That just reiterates that the Fed is going to keep that accommodative monetary policy at least for quite a while.